not this time. Oh, we're on now. What a surprise. So there's been a lot of discussion about how to get into markets that are not overpriced. So we're going to do a show today about finding emerging markets, and you will get that information right after this. Good afternoon, everyone. It's Bill and Jonathan, and our special guest Hunter. We were going to tease him in, but too bad he's already here. Thank you again thank you this time for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management. We are a private lender for real estate professionals in the Southeast. If you have a project you'd like us to take a look at, please go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, all that good stuff.
Excellent.
And don't forget hey, Brian. Wendy. Don't forget about Wednesdays with Wendy. And yes, I will talk right through the graphics. Anyway, Wendy devotes 30 minutes per person on Wednesdays that wants to talk anything about real estate. So there's her link. It will also be on the comments and chat section on the right side or underneath, depending on the platform that you are viewing us from. She usually gets booked out about 2 months in advance. So book your spot now.
Mm-hmm. For everyone out there wondering, I'm 6'2". Hunter's just 7 foot.
Yeah, right.
Yeah, I'm just
I'm trying to keep my head in the frame for you.
I can go ahead and admit that I'm vertically challenged.
Oh, man.
I don't have an issue with that.
No.
So, yes, we have our guest, Hunter Bick. He is with Elevate Capital. We have about a 3-year history with you guys?
Four
and a half.
Wow.
4.5 year history.
It's a great story. We're going to let him tell it instead of me or Jonathan tell it.
And before he tells that, I just want to get some quick information in for everyone. This is some data that we have that will kind of lead into what Hunter's going to talk about, but also about the emerging markets. This is the third month in a row where we've seen rents slow, but they are still rising. Charlotte is kind of, I think, in the top 7 on still rent increases, which is 11.5% year over year. The median rent in Charlotte right now is almost $1,800. And if you've followed the show, you also know that the median house payment for a mortgage is $1,850. So they're right there with each other, which is
that means there's room to grow.
I suppose so. So we're also seeing. Give me a second.
No issues.
We're also seeing a slowdown in starts on single families, and a slowdown in starts on multifamily. However, construction that is in process is up on multifamily by 27% and up on single family still by 4%. So we're still seeing, there's still growth, but Hunter and I were talking a little offline a little earlier, and, as the next month and 2 months comes in, we're going to see that decline and that slowing down hit even harder, and mostly because of the interest rates. Supply chain is picking up. Lumber, as we were talking about earlier, is, back to pre-pandemic levels, which is good. So also, if you're in the way of the hurricane, we're very sorry. I think, Bill, did you lose a home?
Well, yeah, that's what I was going to jump in and say before we got too far into this, that you guys pray for the folks in Florida. We have some short-term rentals down there, but we don't live there full time, so it's not affecting us like it would the people that live down there full time. And there are people that are missing as well, so keep them in your prayers. It's going to be a while to recover where it hit the hardest.
Yeah.
That said, starts almost always do this when there's a coming recession.
Exactly.
People are being a little bit more cautious. Banks are kind of holding off on commercial and residential development because through every downturn, or we'll just call it a crash,
Yeah.
what's the first thing that goes under? And it's the start of a development.
Exactly.
Here's the problem, though. We're still 5 million homes behind where we need to be based on the population growth. So all it's going to do is increase demand for what's out there.
Yeah.
Right.
Yeah. Well, talking about increasing demand, we want to, get Hunter talking here. We want to know kind
We
of
demanded he stop by.
We demand. So wanting to know kind of how you all got started, what was the first project, and then just kind of take us through. And, I'm sure Bill and I will interrupt and jump in from time to time.
Okay, so like
Yeah.
the 3 to 5 minute version, not the 20.
Hey, you take all the time
Okay.
you need. We're
All
on
right.
your time, man.
All right, cool. So our partnership, Elevate Capital Group, got started. Really, we started 2017-ish, mid 2017, and one of our partners was a high school buddy of mine. His name's Matt, and then we met our third partner Shannon pretty shortly thereafter, and we just really clicked really well. And we at the time, even now, but like the whole idea is effectively what we do is value add multifamily, where we can go in, find something that's underpriced because of distress or a bad rent roll or whatever it is.
Mhm.
We can go in, renovate, improve the quality of life, improve the asset.
And you're pulling those off of the MLS, right?
No. Now, the very first one had been on LoopNet, believe it or not. Our very first deal was in an emerging market, so good segue,
Yeah.
in Fayetteville, North Carolina. And it had been on LoopNet. We made an offer, didn't get it, came back to us a few months later, fell out of contract. And it was $2 million for 56 doors in Fayetteville, which in today's world would be
And that was-
absolutely unheard of.
And that was in 2018.
In 2018.
Mhm.
And at the time, everyone told us we were idiots for wanting to buy anything in Fayetteville. And we'll get into that in a minute, but they were wrong. And so we had an appraisal for this property, and we had like $100,000 to buy an apartment building. And we had an appraisal said it was worth $2.5 million. And Shannon and I were talking about it. We were like, well, why don't we put hard money on it? So we came down here to Carolina Hard Money, aka Carolina Capital Management now, excuse me.
Yep.
And showed you guys what we had, and you guys got it, and that's what helped launch us. We wouldn't be here today without that first deal and all the other ones we've done together. And you guys gave us 100% of the purchase and some rental money. 5 months later, that thing appraised for 3.3.
Yep.
And we did a cash out. I think our new loan on it was 2.5, maybe.
Mhm.
Paid you guys back, took some cash out to put towards future renovations, and that's kind of how we found our model. It's basically like a leverage buyout, private equity type model.
Yeah.
And we've done that. We've done 20 deals now. We've done most of them in some similar structure.
I was going to say on this first deal,
Yeah.
it was based on market conditions. It was pretty much fully occupied.
Yeah, it was like 85 something.
Yeah. And while there might have been some updates that could be made, it wasn't that it was in bad shape. It was just outdated, right?
It was compared to some of the stuff we've seen, it was not in bad shape.
Yeah.
It definitely needed some deferred maintenance. It had some issues. That one though, the income statement was where a lot of the value add was.
Right.
Like the expenses were off the charts. Like
Mhm.
the previous owner was. This is no joke. He was spending $400 a month to lease a copy machine. Why on earth does an apartment complex? First off, you could buy one for half of that. Second of all, what is an apartment like? What is it like? Why would that be on an apartment complex's books, right?
It was installed in a new car. That's the difference.
It must have been, right? And so, we knew enough to say, okay, 400 times 12 is $4,800 a month, $4,800 a year. Divide that by a at the time it was like a 7 cap.
Mm-hmm.
I mean, the math on that is big money on the valuation. And so we fixed a lot of stuff like that.
And that's, just to jump in, I mean, when you're looking at these, that it's not what you can increase. Everyone thinks what's the rents that I can increase, and under market rents, that's a great way to look at it. However, this particular asset that when I was underwriting it, it was actually when I joined with Wendy and Bill, this was the first multifamily that I underwrote for them. We could see immediately there was exorbitant amount of expenses on there that shouldn't have been there, that created hundreds of thousands of dollars of value once they just removed them.
Mm-hmm.
No.
Now, I was going to say, on the reverse side of that, if your brother-in-law is going to be able to do stuff a lot cheaper than the market, that's not going to count in the valuation. So something to keep an eye on when you're looking at these things.
Yeah, you can't say well, my expense ratio is going to be 20 when market's 35.
Right.
You can't say that. No.
I mean, you can, but no one's going to believe you.
No appraiser is going to use that. Yeah.
No good lender will buy it.
Yeah.
Yeah, and so the commercial real estate is valued on the operating income, the NOI, the net operating income, the NOI, and that's the game. And depending on the deal, that could be through buying an empty property and fixing it and leasing it to market. It could be cutting expenses from mismanagement.
Mm-hmm.
It can come in many different ways.
Yep.
And a lot of them, the capex, some of them need so much capex that doesn't generate revenue. Like we looked at one where
capital expenditures, things that you have to do to the property, is what capex is. Yeah. Mm-hmm.
Thank you. Yes. And so, but there's different types like roofs, structures, HVAC.
Those things don't add value because people expect a roof and they expect,
Exactly. A lease is a two-way document, and these things are supposed to work per your side of the lease contract. And so you don't get anything for that. But if all of the capex that a property needs is unit upgrades or improving the landscaping or the curb appeal or things like that, those things drive value immediately. And so ideally you want properties that have new roofs and new parking lots and don't need structural work. Yep. And you can just go renovate doors. Now all your capex money is going to where it makes the biggest difference.
Yep. And
so you can see any combination of that. Some deals work, some deals don't, but that's definitely something to look for.
And your typical business model is essentially whatever the best deal is, right? Mm-hmm. It's not just about buy and hold. It could be buy to renovate and sell at the same time, depending on
the highest and best use for the property.
There could be some great offers that are coming in.
Yeah,
it could be. Yeah, when we go in, we don't want to be married to a particular exit strategy.
Sure.
And so if the deal only works if we can turn around and sell it in a year, 18 months, we're probably not going to do it. Right. There have been I can think of a couple exceptions to that, depending on markets and different types of assets. But in general, you don't want to be locked in to one path, because if that one path doesn't work and if it doesn't work and you're going to lose money, that's tough. That's not a situation you want to be in, because real estate's illiquid. Mm-hmm. It's expensive to sell. You don't want to be in a situation where path A, you lose X, and path B, you lose X times 2. Yep. That is not a situation. My job is to keep us out of that situation. Right. Mm-hmm. So everything we do, we want to be able to have the option to refinance it.
Yeah,
or sell it.
Absolutely. Yeah. That's, we talk about multiple exits always. So why is Hunter here on this show for emerging markets? That's because when I talk with him and his partners, what's really important and what they're really good at is sourcing deals and underwriting deals. So much so that, in 2018, they were, in Fayetteville before a lot of people got into Fayetteville. And what we want to talk about is, Hunter, what are some of the metrics that you look at when you're underwriting a project or a property, and maybe it's in a market that you're not familiar with, or you're thinking about getting there, or it seems like it's a great deal, but what are the metrics you look at for those particular markets?
Sure. Yeah. So the first thing I want to look at for any deal is the rent roll, right? Because I want to know, where are these rents compared to the average or the median in that market, mm-hmm. right? You look at some markets where maybe the rent roll is $600. It's like, okay, well that could be high, that could be low. It depends on the rest of the market, right?
Yeah.
And so then the second thing, if it's a new market, we want to see rent to median income.
Yep.
How low are the rents compared to the median income? And if you look at, but that only matters if you look at a bunch of other cities too, right?
Mhm.
Everything's relative. So when we were looking at Fayetteville, for example, in 2018, Fayetteville's rent to median income at that time, it was like 18%. Charlotte was like 32. All these other cities were like high 20s, like Raleigh at the time.
They're 25
30.
and up. Yeah.
Yeah, they're all 25 or up. And then here's Fayetteville, like all the way at the bottom, like way below like every other, 30 other cities. And we're like, okay, clearly the median income in Fayetteville can support higher rents,
Mhm.
In the near future.
And in rents to median income, it's just a hunter's way, or someone who's buying multifamily, or a lender. It's the same way as looking at like your debt to income. It's the exact same thing. So
Kind of at scale.
Exactly, at scale. So it's, instead of an individualized debt to income, it's a generalized debt to income for what are the average people making and what are the average rents.
Exactly. And so you want to have an idea of not only where are rents at this particular asset relative to this particular market,
Mhm.
but what higher rents can this market in general support.
Yeah.
So that's kind of the by
When you
far and
see
away
it
the
at
number
18%, you think it
Super
could
low.
rise.
Yeah, it could rise absolutely. When plenty of other cities are sustaining at 30,
Yeah.
right?
But when you see something at 28, you're like,
Yeah.
it might rise a little bit, but there's not potentially a lot of meat there.
And it may not disqualify it either, because
Mhm.
even let's say it's at 28 or 30 for the market, but this particular asset is still $200 below the average in that
Right.
market. Still a great deal, right?
Exactly. Yep.
So, so you just want to have the perspective of all that together.
Mhm.
The other big one, of course, is what kind of employers, what's the job base, how stable are these jobs? The case with Fayetteville, and we tell the story a lot, but so many people told us we were crazy to be buying in Fayetteville, because obviously Fort Bragg is in Fayetteville. That is the biggest military base on the planet by far.
By personnel. Yeah.
By count, is 45,000 active duty soldiers. It is the home of the U.S. Special Forces,
Mhm.
but then there's another like 30 or 35,000 civilian contractors that work on that base every day. So obviously that's a key economic driver of Fayetteville, no question. They also have a lot of healthcare, higher education. They have the other industries that are doing well and growing.
Yeah, there's support systems all around for that. Yeah.
Exactly. So people were like, well, you're crazy, brother. What if Fort Bragg goes away? It's like, okay. It's like, can we talk in probabilities, please? Because, okay, sure, that might happen. But what is the probability of the U.S. government moving the biggest military base on the planet out of away from Fayetteville? Why would they do that? That will probably never happen. So, I'm a former poker player. Everything's a probability to me. Let's put a probability on this. 0.001% maybe? Sure.
Maybe 002.
Maybe 0.02. Perfect. I can model that.
Yeah.
Great. I'm willing to take that chance to buy something that is half off.
Yeah.
That is literally half of what this asset is worth all day long.
Yep.
No problem. I'm happy with that risk.
Now, do you still have that asset?
We actually did sell that one.
Okay.
That one we 1031'd into the Shrine House.
No, nice.
Mhm.
Now let's start at the beginning. What'd you pay for it?
For
For
Applewood, aka Meadow Point,
$2 million, right?
$2 million, and then
And you sold it. You exited for what?
4.3, 4.4,
And you did
something
that
like
how many years?
2 years.
Yeah, it was
that's
18 months.
18
I think it
months?
was 18 months.
Was it 18 months?
I think it was 18 months.
So not a bad ROI. I would say.
No, that was going. That was going.
Yeah.
All right.
I
we're
wish,
fortunate there.
I wish all of them were as easy to underwrite as that one.
And that one, our thing with Fayetteville too is like the cash on cash yield for buying doors at 40 grand a door in Fayetteville when the rents were like 700 average. The cash on cash was ridiculous. It was like almost double digits, right?
Yeah.
And so we were like, it is only a matter of time until bigger institutions who already love North Carolina notice this.
Yep.
And these properties are going to get bid up like crazy because the cash yield is so good.
Mm-hmm.
And so everything we could find under 50 a door. Like we bought a couple hundred doors under 50 a door.
Mm-hmm.
And we didn't say no. Whatever it was, we said we had to figure out how to own this. And that's what we did. And just a couple years later, man, 100 a door on average. I've seen things trade for 125 a door in Fayetteville, like
Yep.
decent Bs, not even A's or anything. The A's go for 180.
Yeah.
So
Exactly.
That did end up happening. So we were fortunate there, but you trust your analysis. You stick to your guns.
As these larger markets, and even Charlotte is not exactly a major market. It's approaching one, but it's the largest market between Atlanta and say DC.
Yeah.
Right. So we'll call it
in multifamily is a major market though.
Okay.
Oh, yeah.
Well, we'll call it a major market. That said, how do you find, or how are you marketing to get properties in these smaller tertiary markets?
Yeah, I mean, really, it's building relationships. One of our partners.
You don't market, do you?
We don't really do much.
Mm-hmm.
One of our partners, his primary focus is our deal sourcing, and without, we talk about this a lot, but without a good deal that has a lot of money made on the buy, basically, like built-in equity, off market, has a lot of upside once you fix the problems.
Mm-hmm.
You can come up with the most brilliant financial strategy in the world, and you can be the best operator. Once you own it, you can be the best operator in the world, and you can have the best construction crew in the world. But none of that's going to matter if you overpay for a deal.
Sure.
Like, you can't engineer your way into a great return if you're overpaying at the beginning. And so
we always say, you make your money on the back.
100%, absolutely.
Even in multifamily, where you have forced appreciation, because you can only force that appreciation based off of the cap rate, the capitalization rate in that area, and you can only force it to market rents and maybe slightly above.
Mm-hmm.
So there are limitations even there.
Absolutely. And so we realized pretty early, we're like, look, we have to be able to find off-market deals that need a ton of work and have a lot of upside, and that's really where it starts. And
it makes me think of what's was it that one off of Arrowwood?
Victory, aka Greenwood Village Townhomes.
That's okay, Greenwood. Yeah. So this was in Charlotte.
Mm-hmm.
And what was it? 24 units? Is that
24
right?
doors, yeah.
24 doors.
Townhomes.
And
they were big units too.
They were
beautiful.
It's a cool property.
I'm going off memory here, but didn't you wasn't that the highest per door sale for a B asset in Charlotte?
I believe it was. That's what the broker said.
Yeah.
And that was a good exit. And I think those guys did well on the purchase. It was just a rapidly improving part of town. So they hope they did well with it.
Yeah.
But yeah, I think we sold that in the 130s.
For 130 a door?
Ish, yeah, something like that.
And what'd you buy it for a door? Do you remember?
60. It needed a lot of work. We put in 30 at the door.
You did a lot of work on that place.
Yeah. It was a total redo.
This place was located off of Nations Ford Road, but you had the south end was kind of creeping up towards that area, and it was a neighborhood that was turning around.
And that big CPCC
campus
right
across the street from CPCC campus down there.
Yep.
And you guys did a nice job going in and rehabbing that place too, because
thanks.
It had great large apartments. It had 3 bedrooms in some of them, didn't it?
Yeah, I think 2/3 of them were 3 beds.
Yeah. So it's it may have been a B property to start with. When you get a lot of room like that, there are larger families that are moving temporarily because they couldn't find a home in Charlotte to buy because it was so hard to find inventory, and that's the perfect place for people to move in that have larger families too.
Yeah. And when we say A is new construction, and you have B, C, and even D properties. So you have the A, B, C, and D level assets, but you also have the A, B, C, D level locations. So picking up a D level asset in a B location is what Hunter looks for.
Or an A location.
Moda
Landing's an A location.
Yeah.
D asset and an A. And, so that's the best possible.
Mm-hmm.
The D asset in the A location is assuming the price reflects the D asset,
Right.
Yeah.
That's really the dream deal. And they're going Fayetteville like that, where, they were C minuses in an A minus location. And, you just, they've been ignored for 40 years.
Because think about it. We're talking about Fayetteville because that, again, they got in there in 2017, 2018, which, was, a couple of years before. I think really I didn't see a lot of activity there till 2019 from other guys.
So everybody started noticing it.
Yeah, but you realized quickly, it was anything near and supportive to a base that has 70,000+ personnel on it is probably an A- location.
Unless the base goes away.
Unless the base goes away, which is we conceded 0.002. So
And what was unique as well about this apartment complex, there was a certain number of units that were kind of like an Airbnb, right? They had short-term.
you talking about Victory, or are
monthly-
you talking about?
The one in Fayetteville? Weren't there
Oh,
some already
Applewood.
furnished?
Yeah, they were
apartments?
furnished a bunch of it.
Because you had contractors that would come in and want to stay, and that's a perfect thing to do in some of these.
Yeah, and that's not depending on our system is a lot better. We learned a ton since a couple of these. Man, I'd love to go back and do them again.
Yeah,
just because like
we always
know,
learn.
I know, right? What we do for some of our properties now that are in decent proximity to Fort Bragg, what we do is our property manager has like a furniture rental place, and we actually rent the furniture for whatever it is, and then charge an upcharge on that to the tenant. That way, we don't have to be in the furniture storage, furniture maintenance business.
Mhm.
That's a nightmare. So anything, we always look for ways to like smooth out the logistics. Probably you make a little bit less money, but it's well worth.
Yeah.
You make it back in the time and
Nice.
Absolutely.
brain
Awesome.
damage.
Do the question real quick.
Yeah, go ahead.
Yeah. Let's throw up the question of the week, guys, if we could. It's got it. All right. So the question of the week is: we want to know, what metrics do you look at to identify emerging markets? I know we talked about the average rents, the median income. We also look at migratory patterns. We're looking at what are some other metrics that you all look at?
Who the employers are,
The
how
employers.
stable are those jobs?
Yeah. Is it a medical or a base, or is it a telecom service? Those have different weights to them.
Education's good.
Yeah.
A lot of people work there.
Mm-hmm.
Mhm.
It's stable.
Yep.
Yeah. So what metrics do you all look at to identify emerging markets that we didn't list, or maybe some that we did list and you have a better explanation than we do?
I will say that North and South Carolina both are a bunch of medium-sized cities, or a little smaller than medium-sized cities. We have large populations in both states, but they're not. It's not like Atlanta, where Atlanta covers most of the state.
It is
population
Georgia,
to the
yeah.
west.
Exactly.
So there's a lot of opportunities spread out all throughout the Southeast, really.
Yeah.
So yeah, answer that question. Put it in our chat. We'll keep up with it, and we'll talk about it next week. I hate to do this. We're running out of time.
Before we run out of time, I have one more thing. It surprised me. It was a metric that I read this morning that surprised me. One, like in multifamily starts, the Northeast has seen an increase year over year. That I did not. And a 4.6% increase in multifamily starts
Wow.
in the Northeast. It's only beat out by the South, which is at 5.6. Which every other region is actually declining. But
That's
the
interesting.
Northeast is increasing, but we expected the South to, but I didn't expect the Northeast.
I'm wondering if you dig deeper, are those areas that are further outside the larger cities, because people wanted to be a little bit more into the suburbs, and there wasn't enough single-family housing to support those people.
Like remote work, they want more space
Yeah.
next they can, maybe.
Absolutely.
Maybe.
All right, so folks, I know we had a great time, but it ran out quickly. So thank you so much for joining us, and Hunter, thanks for being a guest.
Thanks for having me.
We are Carolina Capital Management. We are lenders in the Southeast for professional real estate individuals. If you want us to take a look at one of your deals, please go to carolinahardmoney.com. Click on the Apply Now tab. If you are a passive investor looking for passive returns, go to our Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. We'll see you next week.